See, this is illustration 1. This is one company, Newton Limited, which is incorporated on 1st of January 2013. It issued a prospectus inviting application for 20,000 equity share of rupees 10 each. So, this is the company newly incorporated, and it is inviting application from the public for 20,000 equity share of rupees 10 each. The whole issue was fully underwritten by three underwriters, Adam, Benjamin and Clayton. So these are the three underwriters who has fully underwritten the whole issue. Adam 10,000 shares, Benjamin 6,000 shares, Clayton 4,000 shares. So total 20,000 shares has been underwritten, which is the total number of shares. Now the application received from the public is 16,000 shares, of which marked application were as follows. See what happens now. The marked application, Adam, Benjamin and Clayton, these are the three underwriters. So if the public is not able to subscribe, then these three people has to subscribe the shares of the company. So these three underwriters will promote public to subscribe for the shares of that particular company, which is underwritten by them, obviously. So they will move their applications towards, they will forward the applications to the public, and each and every application which the underwriter forward towards the public is marked by their own name, or you can say that there is a rubber stamp on each and every application which the underwriter give to the public. Say I'm an Adam, right? I'll promote public to subscribe the shares of the company. Then I'll put the stamp on that application, and then I will give to the public so that that particular person who is subscribing the shares of the company will be marked under my name, because I bought that person, I initiated or I persuaded that particular person to subscribe the shares of the company. So that will basically reduce my liability, because that will be marked under my name. So in the same way, Benjamin and Clayton, which are the other two underwriters, will also forward the applications by putting the rubber stamp on that application and will forward into the public. And whatever number of applicants subscribe the shares, and then that particular number of shares will reduce the liability of the respective person. So the application which has been received is 16,000, of which marked application are as follows. It means that 8,000 shares are basically marked under the name of Adam, 2850 shares are marked under Benjamin, and Clayton 4150 shares are marked. So basically the total of 8,000, 2850, 4150 is 15,000. So 15,000 are basically the marked applications which the company has received, and 1,000 is still remaining, and 1,000 is the unmarked application. It means these are those applications basically which are not marked by any of the underwriter. It means that someone from the public directly come to the company and subscribe the shares. They are not coming through any underwriter. So it means that out of 20,000, 15,000 is marked, 1,000 is unmarked, and the remaining 4,000 is not at all subscribed by the public, and that will come upon the underwriters to subscribe, right? So now in this question, we are required to find out the liability of the individual underwriter. Now we have to find out the liability of the underwriter. See, the solution of this example is statement of net liability of the underwriter, Adam, Benjamin and Clayton. So the gross liability of all these three are given in the question, say 10,000, 6,000 and 4,000 shares. So they are liable to take 10,000, 6,000 and 4,000 shares if public do not subscribe. So this is the gross liability, and out of that, marked applications are 8,000, 2850 and 4150. So basically, if I say 8,000 applications are marked on the name of Adam, so remaining are just 2,000. And if I say Benjamin, 6,000 is the gross liability, out of which 2850 is the marked application. So the remaining will be 3150. So if I say about Clayton, 4,000 is the gross liability, and Clayton is able to attract more people, or they are able to grab more marked applications, which is 4150. So they so probably Clayton will not have any liability to subscribe for the shares. So now what will happen to the unmarked application? This unmarked application will be distributed among the underwriters in the ratio of their gross liability. So the ratio of gross liability is 10:6:4. So the total 1,000 application will be distributed among Adam, Benjamin and Clayton in the ratio of gross liability 10:6:4, which will give the figure of 500, 300 and 200. So the total shares, or you can say that the total of 16,000 will be distributed among the underwriters, and the total will be 8,500, 3150, 4350. So the total 16,000 is distributed among the underwriters. Now we can see that there is a surplus in the Clayton. So this surplus will also be distributed among the remaining underwriters. So the 350 will also be distributed among Adam and Benjamin in the ratio of 10:6, which is their gross liability. So 219 and 131 will be the additional benefit to the Adam and Benjamin. Now the total will 8719, 3218 and Clayton will be at par, which is 4000. Now the net liability of Adam and Benjamin will be 10,000 minus 8719, which is 1281, and for Benjamin it is 6,000 minus 3281, which is 2719. This is how the net liability needs to be worked out. If there is any over application, it needs to be distributed. If there is any unmarked application, it needs to be distributed in the ratio of gross liability, and then final net liability of the underwriters is calculated. So this is how the question needs to be solved. There is one company, Rosie Limited, which makes a public issue of 4 lakh equity shares of rupees 10 each. Rupees 2 is payable on the application. The entire issue was underwritten by the 5 underwriters as follows. So A 25, B 25%, C 25%, D 10%, E 15%. This is how the 100% of the issue is underwritten. Under the underwriting term, a commission of 2% was payable on the amount underwritten. Further, the underwriter was at the liberty to apply during the tenure of public issue for any number of shares, in which case he was entitled to a brokerage equal to 0.5% of the par value of the shares applied for. So the underwriter can also directly apply for the shares, but for that commission of 2% will not be given, only 0.5% brokerage will be given. Application receipts were to be analyzed on the basis of the rubber stamp of the underwriter, who was to be given credit to the number of the application received bearing his number stamp. So applications received which did not bear any rubber stamp were considered as a direct application and to be credited to all the underwriters in the ratio of their respective underwriting commitment. So this is what we have already done in the last illustration. So it is the normal thing. If any such credit being given as surplus was to the result in respect of any underwriter as compared to his commitment, such surplus was to be distributed among the remaining underwriter in the ratio of their respective commitments. So this complete para is the basics of the underwriting, which we have already done in the last illustration, which is illustration 1. So nothing to be explained in this para. As a result of the issue of the following applications were received. So A, B, C, D, E. So 1,02,000, 95, 60, 32 and 50, 1,000 are the respective marked applications which has been received by the company, and 10,000 is the application which does not carry any rubber stamp. It means these are the unmarked application which needs to be distributed among the 5 underwriters in the ratio of their gross liability, that is 25, 25, 25, 10 and 15. So this will be distributed, 10,000 will be distributed among, into that ratio. Let's go, and it says that included in the number of application mentioned against D in the above table was application made by D himself for 10,000 shares. The underwriters were informed of the amounts due to or from them. The amount was duly received or paid. Show with the add of necessary working the entries to record the amount so received or paid. So we have to pass one entry, and also we need to show the working how it is calculated. The underwriter D having the marked application of 32,000, out of this 32,000, 10,000 is the shares which actually been subscribed by himself. So 2% of commission will not be paid as given in the question. Only 0.5% brokerage will be paid on 10,000 shares, and remaining 22,000 shares of D, commission of 2% will be payable. Working note in the solution: A, B, C, D having the gross liability of 1 lakh, 1 lakh, 1 lakh, 40,000 and 60,000 is their gross liability, because 4 lakh is the total equity share and divided into 25, 25, 25, 10 and 15. So this is the gross liability. Out of that, the marked applications is 1,02,000, 95, 60, 32,000, 51,000. Now the unmarked application, as I already told you, is 10,000 and will be divided into the ratio of 25, 25, 25, 10 and 15. So accordingly, we have proportionated the unmarked application. Now the total applications in the, let's say, portfolio of A, B, C and D will be 1,04,500, 97,500, 62,500, 33,000 and 52,500. If you see the column number 4, this is the total application in the respective accounts will be that. Now we can see that A is having surplus applications. So there is a surplus of 4,500. It means that 4,500 needs to be distributed among the remaining underwriter in their gross liability ratio. So we will distribute 4,500 into the ratio of 25, 25, 10 and 15. So it will be 1500, 1500, 600 and 900. Now we have to make the total again. So column number 4 plus column number 5 will give you the final portfolio. So it is 1,99,000, 64,000, 33,600 and 53,400. So these are the total number of shares on the account of A, B, C, D and E. Now we have to find out the final deficit. So what we need to do is simply column 1 minus column 6. So this will give you the final deficit. So there is a deficit in B, C, D and E, and A will be at par. So there is a final deficit of 1,000, 36,000, 64,000 and 6,600 on the account of B, C, D and E respectively. So since 2 rupees is payable at the time of application, so column number 7 multiplied by 2 will give you 2,000, 72,000, 12,800 and 13,200. These are the amounts which needs to be payable at the time of application, and this will be the liability of B, C, D and E of the underwriters. But the underwriter will also receive the commission of 2%. So underwriter will also receive the commission of 2% of their gross liability. So 20,000, 20,000, 20,000, then 8,000 and then 12,000. So these are the amount of commission which is receivable by the underwriters, and this commission is calculated on their gross liability. So in this way the commission at the rate of 2% will be calculated, but you have to take care in case of D, because out of the 40,000 only 30,000 is the part on which commission at the rate of 2% will be paid. You need to take care especially in case of D, where apart from the commission at the rate of 2%, a brokerage at the rate of 0.5% will also be given. So in case of D, if you see 40,000 is the commitment, so 40,000 multiplied by 10, which is 4 lakh, 4 lakh multiplied by 2%, which is the commission, which will give you 8,000, and further 10,000 shares are subscribed by himself. So basically 10,000 multiplied by 10, which will give you 1 lakh, and 1 lakh multiplied by 0.50%, which will give you 500, which is the brokerage amount. So this is how the question will be solved till column 10. The amount due from the underwriters in case of A and B is nil. And in case of C, there is a 52,000 which is due from the underwriter, and in case of D, it is 43,000. In case of E, it is 1,200. The amount which is due to underwriters in case of A and B is 20,000 and 18,000 respectively, and nothing is payable in case of C, D and E. So now you have to pass the journal entry for this. So bank account will be debited by 57,500. Underwriting commission is debited by 80,000. Brokerage on shares will be debited by 500, equity share application will be credited by 1 lakh, and bank will be credited by 38,000. So this is the journal entry which you need to pass. Now coming to the illustration number 3, Libra Limited come up with an issue of 20 lakhs equity shares of rupees 10 each at par. 5 lakh shares were issued to the promoters, and the balance offered to the public were underwritten by the 3 underwriters, Anand, Vijay and Ashok, equally with a firm underwriting of 50,000 shares each. So there is a firm underwriting of 50,000 shares. It means that the underwriters Anand, Vijay and Ashok has to take the 50,000 shares each, irrespective of the amount subscribed by the public. So subscription total is 12,97,000 shares, including the marked form. So marked form is Anand 4,25,000, Vijay 4,50,000, Ashok 3,50,000. So the underwriters had applied for the number of shares covered by firm underwriting. The amount payable on application and allotment were 2.50 on the application and 2 rupees at the time of allotment, and the commission is 5%. So we need to pass the journal entries for allotment of shares, for the commission due to each of them, and the net cash paid or received. Unmarked application are to be credited to the underwriters equally. Benefit of the firm underwriting is given to the individual underwriter. So how the journal entries will be passed, but before that we will find out what will be the actual liability of the each underwriter, because without that we cannot pass the entries. So see the working note number 1, which is calculation of liability of the underwriter. See, there is a gross liability of 5 lakh each, because they have underwritten 15 lakh shares, and the 5 lakh shares are taken up by the promoters. So the remaining 15 lakh shares is taken up by Anand, Vijay and Ashok, who are the underwriters in equally. So the gross liability of Anand, Vijay and Ashok is 5 lakh, 5 lakh and 5 lakh. Now out of that we have to reduce the mark application which is given in the question, 4 lakh 25,000, 4 lakh 50,000 and 3 lakh 50,000 respectively. Now the remaining shares to be underwritten is 75,000, 50,000 and 1 lakh 50,000. Out of that there is a unmarked applications. Out of that there is a certain unmarked applications. Now there are certain unmarked application of 72,000. There is a certain unmarked application of 72,000. So this 72,000 will be divided equally among Anand, Vijay and Ashok, which will give you the figure of 24,000, 24,000 and 24,000. Now the remaining liability is 51, 26 and 1,26,000 of the respective underwriters. Now there is a form underwriting of 50,000 each. So you have to reduce the form underwriting out of it. So after reducing the form underwriting of 50,000, the net liability will be 1,000 in case of Anand. There is a negative 24,000 in case of Vijay, and the 76,000 shares need to be subscribed by Ashok. So the surplus of Vijay will be distributed among the Anand and Ashok equally, because the question specifically says that the benefit of firm underwriting needs to be given to the remaining underwriters in the ratio of their gross liability. So the benefit of 24,000 will be given to Anand and Ashok in the equally, which is 12,000 and 12,000. Now after giving the benefit of 24,000, now we can see that there is a excess of 11,000 in case of Anand, and there is a shortfall in case of Ashok, which is of 64,000 shares. Now the benefit of 11,000 shares in case of Anand will be given to the last underwriter, which is Ashok. So 11,000 shares will be given to the Ashok. Now the remaining is 53,000 shares which need to be subscribed by the Ashok. So the final liability of Anand, Vijay and Ashok will be 50,000 rupees, which is the firm underwriting liability of Anand, 50,000 in case of Vijay, and the liability of Ashok will be 53,000 plus the 50,000 of firm underwriting. So 1,03,000. So this is the final liability of Anand, Vijay and Ashok. So now we have to pass the entry. At the time of subscription, all the three underwriters had applied for their firm underwriting, which is their definite liability, ultimate liability. Of course, they have to apply for that. So 50,000 each. So total 1,50,000 shares is applied by all the three underwriters, and application money is 2.5. So 1,50,000 multiplied by 2.5 will give you the figure of rupees 3,75,000. So definitely initially company has received the money on behalf of share application, and then afterwards at the time of allotment 2 rupees is further payable by each of the underwriter on the number of shares they are allotted. So in case of Anand and Vijay, 2 rupees is payable on 50,000 shares each. So 50,000 multiplied by 2, 1 lakh and 1 lakh is payable by Anand and Vijay. So Anand and Vijay will be debited by 1 lakh rupees. But in case of Ashok, 50,000 is the firm underwriting on which 2.5 is already paid by him. So on 50,000 there is only a liability of 2 rupees at the time of allotment. So 1 lakh rupees for that, and for the remaining 53, which is the additional liability due to non-subscription from the public. So 53,000 multiplied by 4.5, because the total amount needs to be paid now by the Ashok. So 53,000 multiplied by 4.5 will give you the figure of 2,28,500, and at 1 lakh on the firm underwriting of 50,000, the total will be 3,38,500, which is 2,28,500 on 53,000 shares and 1 lakh on the 50,000 shares. So all the underwriters will be debited by 1 lakh and 3,38,500 respectively, and share application money will be debited, and the share capital will be credited by 9,30,500. This is the allotment entry which need to be passed. Now the underwriting commission. If we talk about underwriting commission, all the underwriters are entitled to 5% of the commission. So basically 2,50,000 rupees of commission in each of the case. So underwriting commission account debit by 7,50,000 to the respective shareholders 2,50,000. Now the company needs to pay 1,50,000 rupees to Anand and Vijay each, and company needs to receive 88,500 rupees from Ashok. So bank account debit 88,500 to Ashok 88,500, and 1,50,000 is payable to Anand and Vijay on part of commission. Anand and Vijay account debit by 1,50,000 to bank 3 lakh. So these are the general entries which need to be passed in each of the case. There is a calculation of amount payable by the underwriter is also given in the working note number 2. You can also refer that more clarification.